Hello, my name is Jeremy Gorey, and I'd like to thank each and every one of you for allowing me this opportunity to come speak with you today. Did you know that an increasing amount of companies are requesting credit checks before they hire you? Do not allow your consumer credit rating to stand in the way of your career and your goals. Consumer credit is a crucial part of most adults' lives, but most adults are not informed about their consumer credit rating, and it only becomes important when they have a financial disaster.
Slow down.
I was someone whose consumer credit rating was on the top of my priority list, but after my first financial disaster, I applied for a loan and was denied because of my credit score. That is when I put my consumer credit rating as one of my top priorities and thoroughly analyzed the meaning of consumer credit, the consumer credit rating, and the expectations of companies extending credit opportunities. Today, I will tell you how consumer credit can affect different aspects of your life, how your consumer credit rating is derived, and common good practices to ensure a respectable consumer credit rating. Consumer credit can have a major impact on your life. One aspect of life that is affected by consumer credit is when locating employment. Today, most employers are requesting credit checks with your pre-employment screenings to determine whether or not to offer you a position. If your credit rating does not meet the employer's required credit score, then you will not be considered for the position, even if you are the highest qualified applicant. A financial disaster is another way consumer credit would impact your life. For example, if your vehicle breaks down and needs extensive repairs, you might have to request a loan from a bank to pay for the repairs. A bank's decision to approve your loan weighs heavily on your consumer credit rating, and again, if your consumer credit rating does not meet the bank's requirements, then you can expect not to receive the loan. Not only do banks determine loan approvals based on credit ratings, but they also set interest rates, which is a percentage of the loan the bank charges you for providing the loan service. The lower the consumer credit rating, the higher the interest rate, and vice versa. Now we're going to discuss how the credit bureaus determine your consumer credit rating. Consumer credit ratings are primarily based on three particular criteria, which are positive and negative payment activity, credit request, and debit to credit ratio. Positive payment activity is achieved by making credit payments on or before the due date and completely paying off loans, which will increase your consumer credit rating. Another key element to your consumer credit rating is how often you apply for credit accounts. The more credit accounts you apply for, the more your credit rating will decline. The final major criteria that determines your credit score is your debit to credit ratio. Debit to credit ratio ratio is a percentage of your total available credit you have used. For example, a credit account with a credit limit of $100 that has $50 of debit that has been charged has a 50% credit to debit ratio. Most facilities prefer a debit credit ratio of 30% or below. I can attest from personal experience, being denied for a loan because of an inadequate consumer credit rating is very embarrassing, but fortunately, with some background knowledge and hard work, anyone can have a respectable consumer credit rating and receive approval for a loan. To achieve and uphold a good credit rating requires financial responsibility structured through positive common practices. Financial responsibility is simple. Pay your bills on time, do not apply for too many credit accounts, and keep your credit to debit ratio below 30%. A good way to keep up with your bill payments is to get a calendar that has your bill due dates and place it somewhere conspicuous like on the refrigerator. When applying for new credit accounts, I have noticed with my own consumer credit rating that by applying for a maximum of one account for 3 months, you can keep credit applications from affecting your score. A reliable way to manage your debit to credit ratio is by paying your debt balance each month. Only make credit purchases if you know you can pay the entire amount in cash when the bill is due. If you follow this practice, you will have a debit to credit ratio close to 0% because you're paying your credit account in full each month and not leaving any used credit. Through our discussion today, we have learned that consumer credit is how the customer credit rating is calculated and how to establish, sustain, or repair your consumer credit rating. Consumer credit will impact people's lives from now to the end of time. But why should you have to worry about qualifying for a loan, unfair interest rates, or being hired for a job because you're uninformed about your credit? The answer is you should not worry, because with some knowledge about consumer credit, you will know whether or not you can get a loan by just understanding the loan facility's loan criteria. Don't be embarrassed the next time you have a financial crisis or apply for a job because you have a bad consumer credit rating. Get in contact with the credit bureaus and find out what your credit rating is today. Thank you.
You sound, Carson, there like you'd earned a raise.